All right, what is up, traders? What's up, tycoons? Super excited for today's video. So much data to cover. This right here is going to be one of the most important data sets that you want to pay attention to, and it's about the amount of money being flooded into the Treasury market. Okay, and this is why you're seeing TLT continue to make new lows. So we're going to go over that. We're going to break down a lot of things in the market. Okay, positioning in Treasuries, U.S. Treasury yields. We're going to cover a lot. Okay. Things like investor appetite. We're actually seeing this still continue to rise. Financial conditions. Okay. Lots of things we're going to break down, regarding, Treasury yields and the bond market, as well as the stock market. We'll talk about some sector leadership, and, why potentially we could be bottoming in here in October. What are the odds of that? We'll go over some GDP forecasts, take a look at a bunch of really good data in today's video, as well as commercial bank credit card interest rates. We have student loans restarting. All right, we'll also talk about some of the airline stocks, retesting their October lows, and, defensives also just getting absolutely obliterated, okay? And those also retesting their October lows. So we're seeing lots of a bloodbath in many different sectors of the market, okay? Not just bonds, not just treasuries, but also in defensive sectors, which you think if the S&P has been dropping, that those defensives would actually be, performing pretty well. All right, Tesla, getting absolutely obliterated today after its earnings call. There's a gap down here that I think it can potentially fill, and I'll be very interested in, going long Tesla again if we can get this gap fill. This blue line is here, our 200-day moving average, getting very close to that. And of course, we've got to break down TNX, our 10-year Treasury, as well as TLT. So be sure to smash the like button, subscribe to the channel if you guys are new. But as always, the content provided on this channel is for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. If you're new to the channel, I do want to mention I started a completely free newsletter for you guys called Investment Intelligence. There's a link in the description to sign up for that, giving out free, valuable finance content, as well as I try to sprinkle in some free trade ideas in there as well. This was one on Tesla, over a month ago, almost 2 months now. And you can see how that trade turned out. This was another trade idea on SWK, Stanley Black & Decker, highlighting the rising wedge, going over where we thought price could come down to. And you can see that that one played out very nicely here as well. Okay, and if you're ever interested in learning some of the strategies that I use, okay, and you want to book a one-on-one session with me for, basically trading or anything like that, you can use the link in the description to sign up for my Ko-Fi page, okay? That's where you can book the one-on-one sessions. Now, through September, a net 1.76 trillion plus of treasuries has been issued this year. That is higher than in any full year in the past decade, excluding the 2020 pandemic surge. Okay, so if you take a look at this, this data is through September. We're already in October now, almost done with October, and it's surpassed all of the other complete years behind it. Okay, this right here is a big factor into why the bond market is selling off so much. It's not the only reason, but this is a very, very big reason. And I'm going to keep trying to drive this into people's head. And there's still tons of money left to be issued, and basically more money going to be flooded into the Treasury market, all thanks to, Janet Yellen. Okay. Now, positioning in U.S. Treasuries is still bearish. And we can see that the blue line here is the 2-year bond. All right. The light blue line here is going to be a 10-year bond. And this is just very bearish positioning, right? And, through October, we're seeing this, bearish positioning here. Now, U.S. Treasury yields are overshooting to the upside due to consistently strong economic data, and they are taking the dollar with them. So this is another reason why we're seeing, bonds continue to collapse, right? We talked about one of the main big reasons being, Yellen flooding the Treasury market. But, when you take a look at the retail sales that came in, when you take a look at the labor market, a lot of this data is actually suggesting a strong economy. And the bond market, I've covered in a previous video, one reason that, yields go higher is because the economy looks strong. Okay. And, these are some of the factors going into why Treasury yields continue to climb up higher, even though the bond market, even though that it seems like they should be starting to peak and come down. And, the Fed is supposed to be pausing and potentially even cutting rates soon, is what a lot of people are saying. But that's a story that's misleading, right? And when we take a look at this, we can see that this is also causing to tighten financial conditions, all right, by these U.S. Treasury yields. All right. And meanwhile, investor appetite for bonds has surged. Okay. And so you're basically paying attention to the orange line here. This is for bonds, the risk appetite. And so as these yields are continuing to climb higher, investors are looking at bonds as a place where to put their money. Now, in my opinion, this could be one reason why we're seeing things like defensive sectors like the staples, utilities continue to get, be in stuck essentially in a bloodbath, is because they're saying, well, hey, a lot of times people invest in those for the low volatility as well as the dividend yields. And right now, you can get a really, really attractive dividend yield, or rather than dividend yield, you can get a really attractive yield from U.S. Treasuries and the bond market. So, in a sense, they're saying, hey, well, why would I, invest in utilities or staples when I can go to the bond market and potentially get that risk-free dividend, that risk-free yield from those U.S. Treasuries? So, even though it's continuing to go lower, things like TLT continue to drop. All right, you're seeing a lot of people still buying into these bonds. Now, the higher yields and a stronger U.S. dollar have pushed the Goldman Sachs U.S. Financial Conditions Index to its highest in a year. So we're seeing financial conditions tighten a lot. And I think Jerome Powell is going to talk about that in today's speech. Okay, I'm recording this intraday right before the speech. And I think that he's going to be mentioning this, and a lot of people are suggesting that he's going to hint that he's going to pause because Treasury yields rising at the pace that they've risen is really helping out the Fed's mission and goal of tightening financial conditions. Now, even when you take out the tech impact, right, and you take a look at the equal weighted SPX, which is down 1% year to date, it's still showing a gap with real yields. So you have the S&P 500 equal weighted index price to earnings ratio right here in black, and then you have the US 10-year real yield percentage. Okay, and that's essentially what we're looking at, and you can see this large gap. Okay, these gaps, they tend to close over time, right? You can see the gap in here, you can see the gap in here, and then those gaps close. And so the big question is which end is going to be the side that corrects and ends up closing this gap. Now, rising 10-year Treasury yields that had really killed the stock rally in August and September, not so much downward earnings estimate revisions. Lower yields now should push stocks higher. Now, we haven't really seen, Treasury yields go lower yet, all right? They're still climbing, all right? And I really think that the 10-year is going to hit at least 5%. I got very close to it today, but if they do actually start to come down, they should, in a sense, push stocks higher. So, if we do end up seeing a peak and we do see Treasury yields start to top out at some time, that could be a little bit of a tailwind for the stock market and for equities. Now, sector leadership tends to turn defensive post the final Fed hike in the cycle. So what you're looking at here is the relative U.S. sector 6 months returns post the final Fed hikes. Okay. And so we talked about defensive bleeding here, right? And we've seen, utilities, staples, things like that bleeding a lot. We'll take a look at that some more. 6 months after the Fed's final rate hike, look at what starts to really outperform here. Okay, you see insurance, staples, utilities, banks, healthcare leading the way over here, and then you see energy, discretionaries, materials, IT, telecoms. Those are going to be some of the laggards there, some of the underperformers. So we'll have to see if this is going to be the same type of environment that we end up seeing once we get the Fed's final rate hike, if we haven't already got it. But for now, we're not seeing that, right? So if we did already get the final Fed rate hike, the market doesn't seem to believe that, right? Because why? Well, staples and utilities, healthcare, they're not really outperforming right now. They're actually underperforming, and they've been bleeding a lot. Now, you can pick a reason, but stocks tend to bottom in October. In fact, 7 of the past 18 bear markets or near bear markets have ended in October. Okay, and so here we are in October, and I think that personally we did put in a bottom here in October, and I'm kind of betting on a end of year rally. Now, of course, That's just my opinion. I have a little bit of data to back up some of those opinions, and I keep sharing that data with you guys. But ultimately we'll have to see how things turn out, right? We can't predict the future and know the future for certain, but we can use some of this historical data to help us come up with our theories. Now, the Atlanta Fed's GDP now model estimate for Q3 GDP growth increased to 5.1% from 4.9% on October 5th. Okay, so again, this is kind of falling in line with that. Treasury yields have been rising because of good economic forecasts. Okay, so they're rising because Janet Yellen is flooding the market. They're rising because of good economic forecasts. They're rising because Japan and China, the two largest holders of U.S. Treasuries, have been selling a lot. All right. And all of this combined together is really just what's pushing things like TLT lower and continuing to push Treasury yields higher. Now, globally, the sectors with the strongest triple momentum, this is earnings, price, and news, are software, insurance, and consumer discretionary, right? So if you look at the triple momentum for the 25 largest stocks globally by market cap, it's most positive for NVIDIA, Berkshire Hathaway, and Google. Google looks great, okay? Out of the Magnificent Seven, this one to me has one of the best looking charts. NVIDIA, everybody knows about NVIDIA and, the whole AI boom and in what they have going on there. But it's very expensive. Okay. I mean, the stock has went up hundreds of percent. Google, which is Alphabet, all right, has a very nice looking chart to me. And I think that originally people were sleeping on them. Okay. They had the whole incident with Bard, and, Bard messed up at one of their presentations. That's Google's AI. And people thought Google was absolutely done and over with. And now, Google's performing very well. All right. And it looks pretty good to me. I'm not in Google. I wish I was at the time, but it's a position where, something where I may look to build a position for this potential end of year rally. Now, we expect S&P 500 margins will trough at 11.2% in 2023, but remain below the 2021 record high of 11.8% through 2025. All right. Now, so basically what you want to look at here, all right, is we have communication services, energy, materials. This is the S&P 500 right here. All right. So, basically this is what they're talking about. The gray lines in all of these are the current. Okay. And then the Goldman Sachs forecast. All right. And you have the 2025 forecast kind of in that blue dot right here. All right. And this is basically summarizing, the sentence that I just read to you guys. But basically margins for most sectors will remain near their 10-year highs. And this is, as of October 5th, 2023. So we've started to get a little bit of earnings since this data has been put out. And, we're going to continue to see some more earnings. We're really right in the thick of earnings season right now. Tesla just reported crashing. Netflix did amazing. All right. And actually skyrocketed after earnings. That was very nice to see. Global PC shipments fell 9% year over year in Q3, but there is evidence that the PC market's decline has finally bottomed out. So that'll be really interesting to see how that plays out for, something maybe like Microsoft, or you have Intel, basically saying that the PC market's decline has finally bottomed out. If that'll be true, then, that could be another tailwind, for some of those companies, right? We're taking a look at some of them here. We have Apple, we have Lenovo, HP, Dell. Okay, and we'll have to see how that plays out. Now, interest rate for commercial bank credit cards continues to soar. It's now at an all-time high. We're continuing to see Treasury yields climb, and we're continuing to see interest rates climb as well, just at an extremely rapid pace. Only 24% of student borrowers surveyed say they can make their full monthly payment without reducing spending. A lot of people are kind of brushing off the student loan payments, but when you combine everything together, when you combine the consistent increase in the price for insurance, right, for auto insurance and just insurance in general, when you take a look at the rising rents, when you take a look at, the real estate market and how expensive it is to buy a home now because of Treasury yields, you take a look at the credit card interest rates right here. All of this stuff is combining together. And then on top of that, you add in, now you have to make your student loan payments. There's a lot of headwinds for, these people basically in this generation that have to, pay these student loans. And I kind of went over a lot of the things that they're battling currently at the moment, whether they're renting or own a home or, leasing or, own a car. Everything is basically just more expensive for them. Now, the ratio of S&P 500 Airlines Index relative to the broader market is right back to its pandemic low in May of 2020. This is the JETS ETF right here. And you can see that these were the October lows when the S&P bottomed out, and we're coming back to those levels, retesting those October lows, just seeing airlines get absolutely obliterated. I mean, it's just been a straight line down. Now, in my opinion, a lot of this has to do with energy prices as well. We've really seen energy prices skyrocket, and obviously fuel and oil and gas and things like that is going to be, a large expense for these airlines. And if those prices continue to just rise at a rapid pace, I think that's one of the stories and narratives really dropping the airlines, as a sector as a whole, right? This is the JETS ETF, so it's not like it's just United Airlines selling off or American Airlines or Delta. It's really all of the airlines just getting absolutely obliterated. We've seen internal destruction among defensive sectors. So this is going to be staples, healthcare, utilities. It's now on par with the Black Monday panic, the 1994 bond market panic, the internet bubble panic, the post-Enron panic, and the great financial crisis panic. Okay. And again, we're talking about internal destruction among the most defensive stocks. Okay. And we're talking about defensive being staples, healthcare, utilities. All right, this is staples, healthcare, utilities all on one chart. Okay, you can use something like TradingView or Thinkorswim to actually combine tickers together, right? So we have XLU, XLV, XLP right here, and you can see this thing also came back down and retested some of the lows in October. We're just seeing a huge bloodbath across multiple sectors of the market, whether it's the airlines or whether it's defensive such as these. The bloodbath has not been spared or limited to just one specific sector. We're seeing it under the hood across the market in multiple sectors. Now, this is Tesla right here, okay, also bleeding tremendously. It's got that gap to fill right around 220 is the top of that gap. At the time of this recording, it's bouncing off of that gap fill. We'll have to see, if this gap ends up filling sometime soon. We've got our 200-day moving average right over here, right around 215. If this continues to go lower, it's going to get really close to that 200-day moving average, and we'll have to see what's going to happen there with that 200-day moving average. Now, this is our TNX chart. Okay, and so TNX, we were looking originally to see if our wave 5 of wave 3 had topped out. Okay, and we were looking for a correction. We were saying, we hit the first price level here at 4.89, and we wanted to see if we can get an A, B, C down for our wave 4. But we've continued to push higher, right? Now, these are the price targets for wave 3. Okay, for wave 5 of 3 is anywhere from 5.121 all the way down to 4.715. We exceeded the first one, right? We exceeded the second one. And so now we're going to see, if we're rejecting the top of this trend line here, we can see that there's basically very systematic buying going on, right? And when you take a look at as we did it before, the amount of massive positions and shorts on US Treasuries, a lot of this looks very systematic and algorithmic almost. It's just continuing to rise in a very structured fashion. And so we'll see now, do we reject off of this trend line and continue heading lower, or do we consolidate here and continue to push upwards, trying to potentially get to that 5% yield on the 10-year Treasury? So for TNX, I'm looking to see if we can potentially get to 5.04 or 5.121. Those are going to be, if we haven't topped out yet for this wave 3 here, those are going to be your next two price targets to the upside. If we are topping out, then you would again look for that pullback, and you would be looking for an ABC structure pullback. So you look for an initial bounce down, then another bounce up, okay, and then a continuation of the move down. There's a gap right here to fill on the TNX, right around 4.4. Okay, and so I think that that's going to be potential pullback territory if we do get a pullback. It doesn't have to go that low. It can actually even go lower, but these are just some of the guidelines, right? It can go all the way down to 4.128 and potentially still continue its bullishness up. We'll have to see how the Fed talks to the market today and what he's going to do. If he comes out pretty hawkish, it's very possible this thing could come up and hit that 5% trend yield on the 10-year Treasury as soon as today, right? But otherwise, if he comes out and he kind of talks the bond market down, talks the stock, talks treasury yields down, then that may potentially begin our pullback process for wave 4 on the 10-year treasury. A lot of this is the reason, and basically how bullish TNX looks, is a lot of this is the reason why I think TLT can come down and hit 80. Now, I know people have a lot of opinions on TLT, and obviously I'm giving mine in this video, but know what you're doing, right? And what I mean by that is stick to your plan. Okay. When we were coming down to these levels over here, I was mentioning, hey, honestly, I think TLT can come all the way down to $80. Now that's just a rough guideline. It could be 78, it could be 82, right? You can see we're pretty close to $82 right now. But people were saying, hey, the bond market bottomed here. Bond market bottomed here. We just made new lows yet again in TLT. Okay. And as a general rule of thumb, okay, you typically don't want to be shorting something that continues to make new 52-week highs, and you typically don't want to be longing something that continues to make new 52-week lows. Right now, it's very possible you can catch those dead cat bounces. All right, and catch some of these moves up. Maybe you caught this move up. Okay. But you'd rather see something show signs of the bottoming process and show a bottoming process versus just, buying in because something made new lows. Oftentimes, as I mentioned before, you typically don't want to long something making new 52-week lows. And the potential for it to continue going lower, in my opinion, is going to be greater than for it to just all of a sudden reverse very rapidly. Okay. Now, we went over a lot of the factors from a fundamental standpoint of why TLT can continue to go lower. The Fed is just issuing, tons of bonds into tons of money into the bond market. Okay. So a lot of the economic data coming out has been relatively good. And so that's also pushing treasury yields higher, which is going to result in things like TLT going lower. If you take a look at your MACD right here, we're very, very close to getting a bearish crossover. Okay. The TLT daily chart MACD has been a really good buy and sell signal. You can see, once we got a bullish crossover here, we had a nice little bit of bullish momentum, bearish crossover here, huge sell off. And now we're potentially getting a bearish crossover again. This is something you want to watch out for. Right now, if you're bullish, you're going to want to see this curl back to the upside. Okay. But if this thing gets its bearish crossover and continues to head lower, again, that's going to drag TLT down closer to that $80 price level here for TLT. All right. Now, if you're getting TLT and you don't have a plan, what you need to figure out is, am I looking to call the bottom? Okay, basically, right? Do you want to be the person who's trying to time the bottom and call the bottom on TLT and call the top on, the Fed funds rate and basically time the Fed's fund rate and say, hey, they're going to start cutting rates very soon. Okay, there's nothing wrong with doing that, but you have to know, what you're doing. Okay. Or are you the person buying into something like TLT because, hey, you think, hey, well, a lot of this economic data could be wrong. Maybe I think that we're actually due for a recession in the next year or two. And maybe I want to hedge my portfolio with some bonds because they actually have really attractive yields. And if we do get some type of recession, or the economy really starts to turn south, it's very likely that the Fed is going to cut rates. And if the Fed cuts rates, then it's also likely that you're going to see things like TLT go up. Okay, so you want to have a little bit of a game plan and not just buy into these things blindly. A lot of people have mentioned that people like Stock Mo are out here just, shilling TMF, which is, a leverage version of TLT, essentially a 3x leverage version. And I mean, you've got to be underwater if you're in something like that right now. So, keep an open mind. Okay. Stay patient. Remember, cash is a position. All right. You don't have to force a trade. You can wait for clarity. And good luck in your trading. Stay safe out there, and appreciate you guys watching the video. Don't forget, sign up for that newsletter, Investment Intelligence. Head on over to my Ko-Fi page, click on commissions here. That's where you can book 30-minute and 1-hour sessions with me directly. All right. The link for the newsletter is in the description below, and I'm out.